What's up guys, welcome to the new video lessons of the week, and today we're going to talk about why small caps and bigger market caps are different. So while we used to be trading our 50 million to 500 million or under, now we're dealing with 2 billion, 10 billion market cap, and we're looking for that massive drop like penny stocks and people keep shorting into these. First, over extended charts of billion market cap, they tends to come down very slow. So I'm not expecting this to go from 11 to 8 in a day. And basically, you want to trade these, you have to swing. Then they do not have good enough risk reward for intraday with a really good pattern. And I see people keeps over trading and keeps shorting into all those trends, and they all got squeezed. Then each time you don't get squeezed that much because their range are really small, but people tends to use a bunch of leverage on those CRON and TLRY, and I don't suggest doing that because with larger market cap, you don't know what's gonna do. As we mentioned, crowded trades are really unpredictable. Then it's almost the same thing because crowded trades are more volume and more dollar put into this specific ticker, and with billion market cap it's also the same thing. There's more money and volume put into this same ticker, and they start becoming super unpredictable, and you're looking for this morning spike to fail, and they can go higher than you think, or they can go even higher and squeeze you out. So all those things are really difficult, and I see a lot of people losing money on these. And you don't trade the pattern you don't know, because I have traded CRN a couple times and I lost small almost every single time. And people are looking to catch something like CRN drop from 11 to 8 because Centron Research released some bad news on them, and it turns out ultimate bounce back all the way to where it spikes to. So all those things, you don't really know what's going to happen next. And as small caps, with all the back orders, you can know what's going to happen in the next 10 minutes after market open. But on these, it's very unpredictable, and also you have to use leverage to make something out of it. And once they squeeze you, you lose a huge, you don't even know why. And that's something I always emphasize in the market. Trade something you know, don't trade something you don't know, and that's just purely gamble. It's probably less winning percentage than gamble. Other ticker I'm going to talk about is GMP on Friday, and it fades all the way back, so looking to maybe some bounce into the 2.4 area to short into, and they didn't trade that much volume, so that means less size and more breaking your positions into several parts to add into, because smaller volume tends to have higher spike than you expected. So that's why you have to break your positions into several parts to be able to get a really good average. That's my general thoughts on all those little volume traded tickers. And I will be hosting a UCB conference, or more like a presentation, and it's free to come. You guys, if you guys are interested to learn more about penny stocks, to learn more about psychology behind it, how does it work, how does the pattern works, you're more than welcome to come. And I will put a link in my website, and it should be up on Monday or Tuesday, so you can go ahead and register your spot. There's only a limited amount of spot. Yeah, if you're interested, make sure to check it out. Thank you very much, and you have a great day.